Hi, my name's Peter Smith and welcome to this very brief video. In the centre spread of the April issue of Economic Review, we provided a flowchart to show how monetary policy is expected to affect the economy. And this video talks you through how this process is intended to work. Let's first look at the traditional approach, which was use the interest rate to affect the economy. Now, the Bank of England was given independent responsibility for monetary policy in 1997 as one of the first actions of the new Labour government under Tony Blair. Prime aim was to convince economic agents that the government was serious about controlling inflation. And the Monetary Policy Committee, the MPC of the Bank of England, met every month to monitor the inflation target. If inflation was threatening to be too high, the MPC would raise the interest rate, or the bank rate, in order to reduce inflationary pressure. Raising the bank rate would affect other market interest rates, as it was a signal that the bank was taking action. This would also affect asset prices and expectations and confidence, not to mention the exchange rate. These changes, taken together, would dampen the domestic demand for goods and services, and the exchange rate adjustment would reduce the competitiveness of UK goods, leading to a reduction in net external demand. This would mean a reduction of total demand in the economy, reducing inflationary pressure in the domestic economy, and influencing inflation itself. Furthermore, the exchange rate adjustment would affect import prices, helping to control inflation. If the bank saw a need to avoid recession, then a reduction in bank rate would have the reverse effect and stimulate aggregate demand. Now, this was all very well until the financial crisis, when the picture changed rather dramatically. With bank rate at its lowest possible level, and the economy heading into recession, what could the authorities possibly do? Bank rate could not be reduced further, so an alternative way of affecting aggregate demand was needed. And the method chosen was known as quantitative easing. Flowchart used in the Economic Review, which I will now discuss briefly, is based on one that appeared in an article published by the Bank of England, and a link to this is available elsewhere on the website. The starting point for quantitative easing is that the Bank of England use electronically created money to buy high-quality financial assets, with the stated aim of improving the flow of credit in the economy. In particular, this would help firms to obtain finance for investment. The initial impact of asset purchases was to give economic agents confidence that action was being undertaken. The purchases would also provide clear signals of policy intent, would encourage a rebalancing of individuals' portfolios, and provide market liquidity and increase the supply of money. And this was thought to be especially important as firms were having difficulty getting the funds for investment, as banks were not eager to lend given the problems that they'd been facing. Now, the improvement in confidence would affect asset prices and the exchange rate. It would affect spending and income in the economy. Could also, of course, affect inflation if spending and income began to rise, but this was considered less important than the recession that was building. And indeed, inflation was expected to decelerate into the future, as indeed it did. These other effects of the asset purchases, the policy signalling, rebalancing, and the effect on market liquidity, would work together to reinforce the effects on asset prices and the exchange rate, and the increase in money supply would operate to reinforce it as well through the effect on bank lending. The adjustment in asset prices and the exchange rate would also have the effect of reducing the cost of borrowing and expanding total wealth in the economy, which in turn would affect spending and income. Again, this would affect inflation, but this was not an issue at the time. So that's the way in which a change in quantitative easing through Bank of England purchases of financial assets could be used to mitigate the effects of recession, even when bank rate was at its lowest point and could fall no further. And for many, the key part of this is the provision of credit to allow the economy to function more effectively. I hope you found that helpful. Thank you.